Happy holidays and welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Have you thought about investing in larger properties? Well, that's a whole different kind of financing. Today we'll discuss what you need to know about commercial lending now. And we've got a great guest today on the Real Estate Guys radio program. Are you achieving everything you want in life? What if there was a time-tested way for you to get all you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2021 Goals Retreat, January 8th to 10th, now in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at realestateguysradio.com under events or call 888-489-7723 extension 18. Get your life back on track physically, spiritually, and financially. Attend the live in-person 2021 Goals Retreat on the second weekend of the new year. Click events at realestateguysradio.com to register. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723, extension 18 today. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. With me, as usual, it is our financial strategist and co-host, Russell Gray.
Hey, Robert.
It is the most wonderful time of the year. It's a great time to be getting together with other real estate investors and your friends and family, of course. And we love to talk real estate. I don't know about you, but around the fire, I'm definitely getting the questions. Hey, what's going on and what's happening? And it's a brand new year coming up, and we're all excited about that. As we end the year, we thought we'd talk today about one of the most critical elements of acquiring real estate, and that is leverage. There are certainly people that buy all types of property for cash, but pretty quickly we find out that if you use other people's money, and those other people being banks and lenders and sources we'll talk about today, that you get the benefit of leverage. And it's one of the key benefits of real estate investing.
Well, for me, it's the thing that got me into the business. I really chose to get into the mortgage business way back when we first met, was because I knew financing was the key. When you have anything going on, whether it's cash flow, amortization, or tax benefits, of course, appreciation, leverage magnifies all of that. If you put 25% down on a property, you're controlling 4 parts of real estate for 1 part of equity, but you get all of the benefits from the financing because it's a total capital stack, if you will, to use a fancy term. So it magnifies. A 5% move on the value of the property gives you a 20% gain on your equity because you've only got 1/4 of it in. So that's really the value of financing. And of course, right now, we're at a period of time where we've been in a 40-year downward trend in interest rates, and interest rates are just at ridiculously low rates. That translates, of course, into things like cap rates falling, which means equity grows. And when we have low interest rates, equity happens, something we've been talking about for the last 15 years. So it's something we always need to pay attention to. And so we're going to take a deeper dive into commercial financing today.
Money is the fuel we use to acquire real estate. And when we borrow money, it comes with a cost and a benefit. There are certainly tax benefits. We won't really talk about that today. But the primary idea of leverage is that you, as an investor, owner, equity participant, have a little different outcome in mind than a lender. Now, you can certainly do private loans, and we'll save that discussion for another day, and we've had some of those shows, but a lender is looking for a predictable stream of income, and they're willing to take this lower rate, if you will. And most real estate investors want the upside. They want the upside of the value of the property. They want the upside of rents. They want to be able to fix up the property and increase the revenue or add amenities, and all those things aren't really affected by the mortgage payment once it's in place. Now, if you've bought a house before or any kind of small rental property, you've been through the process. And if you haven't, it's pretty simple. A lender's concerned with 2 things. How are you going to make the payment? And what happens if you don't? So how are you going to make a payment? They're going to look at you, at your income, at your assets, at your credit rating, and then they're going to look at the property. They're going to get an appraisal. They're going to make sure that they understand the durability of the rent and all of that. And for a single family home, or even, up to 4 units, most lenders are looking primarily at you, the borrower. It's you that they're lending to, and they're going to make sure that the property appraises, but it really is about your ability to make those payments. You'll get some credit sometimes for a renter, but not necessarily the primary driver. Now, what we're going to talk about today is something different. We're going to talk today about commercial financing and specifically multifamily, which is arguably one of the greatest asset classes there is within real estate. And multifamily investing is just a different animal. And the big distinction is this: multifamily lenders are interested primarily in the property. And we'll talk with our guest today about this, but it's the property's performance that they're primarily interested in. And of course, they're going to make sure that you're a valid borrower as well. But it is a distinction. I know, Russ, you counseled a lot of folks about this early on because many times people start investing in single family houses and they think, well, I could get an 8-unit or a 10-unit or a 12-unit building thinking it'll be just like their home loan. But it's not.
No, it's not at all. And, sometimes people hear the word commercial financing and they think, oh, I'm going to buy a commercial building or an office building or a shopping center. But, you can still buy residential property. I mean, when you go from 4 units to 5 units, you've just moved into the realm of commercial financing. So a lot of folks don't understand that. But you can still go multifamily and be in what I call residential financing because it's residential 1 to 4 units. And that just really grows out of the secondary markets because you have agency money, Fannie, Freddie, and they back up those markets. And so there's a whole distribution system that I was in that does residential 1 to 4, and then everything else above that is called commercial. And so to your point, Robert, when people look at residential, they look at the borrower primarily, credit score, and their DTIs, their debt to income ratios, and they get some credit, a lot of credit for the income on the property, but they can also contribute some from their own income. Commercial doesn't work that way. It's all very much about the building. And when they look at you as the borrower, yes, your credit score is important. Yes, your balance sheet's important. Those are very important. But another thing that's really important is your experience, because they understand that you're not going to personally come in and save this thing financially if it goes sideways. So where you have to be good is actually being able to operate the property profitably so that you can deliver payments to the lender. So the lender's actually your friend. And the reason is because they're going to underwrite the property maybe even better than you would. And the first couple of times you go through that experience, I can tell you, you learn how to become a better underwriter because the lender's more conservative than you are. And they will point things out to you that you should have seen. And so they can almost be like a mentor to you if you have the right person with you.
I'm glad you brought that up because I know I have certainly felt the frustration of taking a great deal to a lender and having them dice it apart and come up with all their bureaucracy. And I'm like, come on, this thing's great. It's great for you. It's great for us. You're going to make a ton of money. The lender is your friend, but they do also have to do prudent underwriting. And I would argue the lender's better at it than most folks that I've met because they do so much. They have a wider perspective. Your lender might do 12, 15, 20 loans like this a month, and you might do one every 2 years. So not to take anything away from your amazing ability to be a multi-family investor, but you definitely want to view the lender as your advocate. And as you'll find out today, putting a person in your corner that's going to be making sure that everything shows up in a way the lender's going to keep nodding their head yes and not looking for reasons to say no is a critical part of this. It matters who you pick. Anytime you put team members on your real estate investment team, and if you bought a single family house or duplex or something, you probably picked an agent, a lender, a broker, somebody who understands investment property, isn't just lending to homeowners, because it's a little different level of expertise. Well, you're going to magnify that a lot when you jump into the commercial realm because there is no owner-occupied apartment building financing. It's a whole different animal. We're going to learn a ton about it today. We've got a great guest as we talk about multifamily investing and financing on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Our friend Tom Wheelwright says if you want to change your tax, you need to change your facts. When's the best time to do that? At the beginning of the year. When's the next best time? By December 31st. Well, the 12 days of Christmas might not be enough time to close your next property and grab a stocking full of bonus depreciation. There are several other things you can do quickly, and some let you deduct your entire investment from your ordinary income in year one. So we're making a list and checking it twice of several nice moves you can make quickly to change your facts and lower your tax immediately. Want to see it? Just send your email request to taxmoves@realestateguysradio.com. That's taxmoves@realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from January 29th to February 1st in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 15 years now, and with the Belize airport open again, our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful, the people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. Demand for offshore real estate has skyrocketed since the coronavirus shutdown, and with retirees looking for lifestyle, the work-from-home workforce able to be productive from afar, and tourism coming back strong, now may be the perfect time to consider Belize as a place to diversify risk in your investment portfolio. There's all types of opportunity in Belize when it comes to real estate investing, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me at the end of January in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so you can follow up with them after the trip. But that ball's in your court. You'll receive their contact details, but they won't receive yours unless you give it to them. You've heard about Belize and the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, January 29th to February 1st. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events. I look forward to seeing you in beautiful Belize.
Hi, this is Mauricio Raul, founder and CEO of Mir Law Group, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station, all the time at realestateguysradio.com. Happy holidays to you. We thought we'd kind of wrap up the year here with a show about multifamily financing. And if you have on your goal list to own more apartments in the future than you have in the past, you're going to enjoy our guest today. Please say hello to Anton Mattli. Hey, Anton, how are you?
Hi, Robert. Great. Thanks for having me on.
Well, it's great to have you. You have an incredible background in commercial and investment banking and financing, and people probably can already tell that you weren't born in the United States. Tell us a little bit about your background, Anton.
Yeah, sure. That's definitely the case. Even though I've been living in Dallas for now 15 years, I obviously do not have a West Texas accent. I was born in Switzerland. And as many Swiss do, they go into engineering, they go into chocolate making or cheese making, watchmaking, or finance. And that's where I ended up. And so right after school, I went into banking, worked in New York, worked in Tokyo, in Hong Kong. And after that, I left banking and went out on my own, helped family offices and ultra high net worth individuals with their direct investments in alternative assets like commercial real estate. A big chunk was always commercial real estate. And that's really what brought me back to the United States. And I've been involved in that now on my own for the last 15 years. and I'm enjoying it greatly. Multifamily is a big chunk of all that. I'm involved in other commercial real estate classes too, but multifamily is definitely one of the most exciting ones.
Well, it's interesting, right? You work with a family office, and just for folks that don't understand, that's a terminology that we say no investor left behind. A lot of folks get wealthy, they have families, there's lots of heirs, and it may be that they have the chops to invest, but usually they're pretty good at whatever they do to make money. And so they put together a team that helps them make investments. And a family office can be one person, or a family office can be a group of folks with attorneys and investment counselors and all kinds of things. But when you're investing, those are folks that have a lot of wherewithal and a lot of assets. And you're looking at these kind of big, stable investments like multifamily. So I know in your experience in family office, you were involved in multifamily, but from the different perspective. And yet, with the variety of ways that people can invest today, one of the things we always say is that residential in general always has the best financing. And within that, it's multifamily. Can you speak to that? Why is it that multifamily tends to have the lowest interest rates and the best kind of loans?
Yeah, so I think there are two primary reasons for that. One is it's a very stable asset class when we look back at the various recessions we have gone through, including the Great Recession in 2008 to 2010-11, depending on when you say we were out of it. Multifamily we covered much faster than the other commercial asset classes, right? So that is one of the reasons that, yes, you always have dips too, but you recover relatively quickly compared to the other asset classes. The other element that plays into it is the availability of financing. In commercial real estate, there is no other asset class that has that broad of access to financing, debt financing, and that's primarily thanks to, and you referred to it earlier in your show, Fannie and Freddie, that is readily available on the single family side. You also have that availability on the multifamily side, right? So you have Fannie and Freddie providing a massive amount, roughly half of all the multifamily financing in the US. And you do not have that for a hotel, you don't have it for retail, you don't have it for offices, industrial. So that's a massive benefit. So that creates additional competition. And on top of that, obviously, these quasi-government agencies, they want people to have affordable housing. So they are really pushing hard to provide developers as well as property owners with financing that is attractive so that tenants have reasonably priced housing available to them.
Well, and there are, as we're going to talk about, a variety of sources, but having some big sources like that just tells you that it's going to stay competitive, and that we always say you can look at a country's tax law and figure out where they want you to invest. Well, you look at the financing that's available and it shows you what's in favor there. So I think let's do this, Anton. We have a variety of listeners. We have people that are aspiring to be real estate investors. We have very seasoned, sophisticated accredited investors, fund managers, folks like that. And then there's the people that are just acquiring a portfolio. Maybe they bought a single family home or duplex, but they've never bought multifamily. So Russ and I talked about some of the differences, but when you sit down with somebody to talk about financing multifamily, what are the major differences between that kind of a loan and, more of a residential loan?
One of the big differences really, right, when you start out on the residential side, you're used to, and you mentioned it earlier, debt to income ratio and your credit score and your personal income stream. That's what drives essentially the lending decision a lender has. You can buy a property even at 50% leverage. If your personal income stream is not sufficient, they're not lending to you, right?
Right.
So you are essentially restricted by your own personal cash flow. When it comes to commercial real estate, including multifamily, it's a very different story. So now the property's cash flow drives the lending decision that determines how much that property supports for a loan amount. And we primarily use a term called debt service coverage. There are some other terms, but for most loans in multifamily, it's the debt service coverage ratio. Usually it's 1.25 or higher, which means that the cash flow has to be roughly a quarter higher than the debt service that it has to serve. And obviously also that net operating income, as it's called, is also then used with the cap rate to come up with the valuation of the property. And that also needs to be a reasonable level, usually 70 to 80% in most instances. So that is what's driving the underwriting of the loan at the property level. However, there is another aspect to it, and this is also the financial strength of a property buyer or property buyers. And that is a combination of net worth. So typically you need a net worth that is equal or higher than the loan amount.
Okay.
And you need a post-closing liquidity after you make the down payment and close on that loan of, roughly speaking, 10% of the loan amount. So if you have a $5 million loan, as an example, your net worth should be $5 million and your post-closing liquidity $500,000. Right? So that may sound like a pretty steep hill to climb when you start out, and you may only have a million in net worth, right? However, and that's another massive benefit compared to single family investing, and I call it a power of stacking, right? In single family, it's essentially you on your own, it's your personal cash flow. In multifamily, you are able to combine your net worth with other individuals that want to join you. So if you have, let's say, to take that same example of $1 million net worth, but you have a property that requires a loan for $5 million, you may have to bring in 1, 2, or 3 other individuals that have, together with you, that net worth and liquidity that can support that loan. You don't have that on the single family side. So that's really the beauty about partnering up with people. Now, that's on the financial strength side. Now, the other aspect, and you alluded to that earlier too, is that you also need to bring experience to the table. With bank loans, sometimes they are a little bit more flexible, that they're willing to provide you a multifamily loan without any past experience. But it's only when it comes to the agencies like Fannie Mae and Freddie Mac, they definitely want to see that you and or one of your partners has experience in multifamily, typically at least one property for at least 2 years of a similar size, ideally in the market that you are looking at. But it's not always necessary. Again, when it's a bank that is more flexible with agencies, you have to expect that that requirement is met. Now, for some of your listeners, they may have heard me before, and I talked about Freddie SPL, that is more flexible there.
Yeah.
That was the case in the past when they were willing to essentially lend to someone who did not have any multifamily experience, as long as they used the third-party property management company.
Right.
That's no longer the case. So now you need to have that experience that you bring to the table.
So let's talk about some of the why behind this, because I think people who haven't been through it takes a little bit of an adjustment. The whole debt coverage ratio, the fact that the property itself has to generate at least enough to pay all the debt service and then some more besides, is just prudent. You would want that anyway. And as these assets get bigger and bigger and bigger, it starts to be a lot of money, and there's likely not too many individuals that could stomach the whole loss. And so just right from the beginning, this is another way the lender is your friend, that you may have underwritten it based on certain assumptions. The lender's going to come in and make sure that the property, that you're being set up for success. So that's critical. As far as understanding who is involved and how much ballast they have to have, this is critical to get your mind around. Experience is one thing, and net worth and assets is the other part of it. So if you've never been involved in a multifamily property, there are ways to get involved and get that experience. It's the old catch-22. Well, how can I have experience if I don't get a building? And I can't get a building until I get a loan, and I can't get a loan until I get experience. It's just that endless circle. But there are ways to do it. In fact, most of the folks that you deal with, Anton, today are real estate syndicators, people that put together a deal, and there's a sponsor, there's a person that's, putting the whole thing together, orchestrating it. They're likely to be necessary to be on the loan, but they can bring partners in. And there's passive partners that don't qualify for the loan and don't have anything to do with the active side. And then there's the partners that do. So let's talk about that part. It's experience, but it's also their wherewithal. So when someone comes to you and they found a great deal, they've got a 200-unit apartment, it looks awesome, the rents are good, it needs a little bit of work, but it all fits into kind of the formula, and they're missing experience. How do you counsel them there?
Yeah, what I would suggest is to find a partner that has that experience. Right now, what I would suggest is, and I actually just had a discussion last night with a client of ours who did not assemble the team early on. Right, so that individual was putting a bid in and a letter of intent for a property, a very good property in a very strong market. And then ask, okay, so if you win that deal, who will be your partner or partners? And that individual told me, well, I still need to figure that out, right? So that is not really the way I suggest to go.
Right.
Ideally, you already talk to people that have an experience, tell them what you plan to do, what your strengths are, what your weaknesses are, and assemble the team before you even ever make an offer. And that is really my recommendation.
Now, Anton, is there a guideline about what percentage of the deal a person has to have before the lender's going to look to them?
Generally, it's 20 or 25%. If someone invests more than 25%, then the lender will actually underwrite them as we call it, even if they do not guarantee the loan, right? But frankly speaking, in syndications, that's pretty unusual. It happens when you have more kind of joint venture type of partnerships or tenancy in common deals, like for 1031s. You may get a little bit too technical here. That's when you have these high percentages. But usually, most, even in syndications, the largest that we typically see is a single individual may probably having 5 to 10% of the cash invested. So it's usually not coming into play. What is still important is, since we talk about actual cash investment, lenders still, particularly today, want to see that also the sponsors have some skin in the game, right? So you cannot just put a deal together and think that you do not have to invest any money. You do not have to invest that much. If it's a really solid deal, maybe just 2 to 5%. But if it's a tougher deal and it's your first deal, you may have to go up to 10, maybe even 20% of the total cash investment.
Now let's talk about deal size, because there are often some minimum investments and there are properties that get kind of stuck in the middle. But what's usually a minimum loan size that folks would consider?
Yes, so for agency loans, they start at 1 million as a loan amount,
Okay.
right? So if you are below that, we generally recommend to go with a local community bank or credit union. Don't walk into Chase and think that they are excited to provide you that loan, right? It's just not going to happen unless you have a massive portfolio with them already, and then you probably will not just look at the property that has a sub $1 million loan anyhow. So that's generally the best way, because it's much more relationship driven with credit unions and community banks. Once you get above that, it turns more transactional, and that includes Fannie and Freddie and HUD and CMBS lenders and other lenders. And that's where you really open that box to a much broader variety of financing that is available.
So, hey, before we're done, Anton's put together a really cool kind of tutorial on commercial multifamily lending. So if this is new to you, don't feel like you have to be taking notes or rewinding. It's called The Ultimate Guide to Financing Your Apartment Complex. And I appreciated in this report, Anton, how you went through and talked about all these different sources, the difference between Freddie and Fannie. They're two different things. You talked about CMBS loans, you talked about HUD and FHA, you talked about banks and private loans, even insurance companies and other sources. So before we're done, we won't get into the weeds right now on the individual differences, but for those of you that want to brush up, you certainly can do that. I think one of the things people have to understand about this whole segment of multifamily financing is that it's been around a long time. It's been proven. The interest rates are great, better than ever. And yet But there have certainly been some changes in the world because of COVID. So let's touch on that real quick. What are the things that have happened since the world was shut down, people lost jobs, tenants were unable to pay, and sometimes landlords were unable to make their mortgage payments?
Yes. So initially, that was in the middle of March. As you remember, the whole world seemed to fall apart, right? And that included also capital markets, as always. When everyone is running for the doors, capital markets are shut down too. And that was the case for a very brief period of time, luckily.
Yep.
The result was that only CMBS loans disappeared virtually overnight, so you weren't able to do anything. Bridge lenders, a lot of them shut shop, and they never came back.
Right.
Agency lenders, some of them had to postpone their closings because they were not able to get their own funding to fund that loan before they can sell the loan to Fannie or Freddie. But all that was really just a very brief period of time until it settled again in the multifamily space. The other commercial asset classes, naturally hospitality and retail, they're still suffering and they haven't recovered and will likely suffer for some time. On the multifamily side, the lenders, including Fannie and Freddie, implemented very quickly new regulations that allowed them to still lend, but also implement safety cushions for them in case COVID-19 would create severe distress on the properties that they finance. Initially, they initiated reserves that included everything from principal and interest to insurance to taxes, essentially everything that you can toss in there into reserves. But that was just a brief period of time. And after that, they focused on principal and interest reserves. And that is still has still stuck around, and I expect that still will be the case for at least another quarter, maybe 2 quarters, until we really have a clear path out of this situation. So depending on the program and your leverage, your principal and interest reserves will be somewhere between 9 months for a Freddie conventional for a full leverage loan, all the way to 18 months in the worst case for a Fannie small balance loan, and somewhere in between, like a Fannie conventional is 12 months. And as you go down with leverage, it might be a smaller, a shorter period. And if it's a really low leverage, typically 50 or 55 and below, then that principal and interest escrow requirement will fall away completely. Right. So it's kind of a very logic approach that they take. The higher the leverage, the higher the reserves have to be, and the lower the leverage, the less they need. Now, what is important is, right, I mentioned for Fannie small balance, they want 18 months. On the Freddie's SBL, which is the small balance program, they want 12 months rather than 9 months on the Freddie conventional. So clearly they make a difference between these programs, right? The small balance, which is essentially up to 6 million for Fannie and Freddie SBL, if it's under 100 units, it goes up to 7.5 million. So there, clearly they make a difference, and there is a reason for that. When you look at the loans that they have in their portfolio that are in trouble, the small balance loans have a much higher default rate. People are asking for more forbearances, and a lot of these loans are also falling into default or are just not meeting the requirements. So they may not be in default, but they are on the so-called watch list because the debt service coverage is now below of what it's supposed to be. So clearly smaller properties tend to have are struggling more than the larger properties. And the reason for that is not necessarily the property size, but very often the experience of the operators, right? It may be their first property, it may be their only property, and as a result, the risk is just higher there. And that brings me to the point I mentioned before. That's why also Fannie and Freddie are now focusing much more on the experience of the buyers because they recognize the properties when they dug in even deeper of the small balance loan that were in trouble. Very often it was first-time buyers, right? So they figured out, well, I think we need to really look more at their experience. And if we restrict to completely newcomers that do not have any experience, I think we can reduce the risk going forward.
Our guest today is Anton Mattli. We're talking about commercial financing, specifically multifamily. We'll find out the best way to work with a professional in this space when we come back, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Hear ye, hear ye. Registration is now open for the Real Estate Guys 19th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year are sales legend Tom Hopkins, the editor of the Gold newsletter Brian London, international real estate developer Beth Clifford, and Jim Rohn's 18-year business partner Kyle Wilson. And joining us live and in person for his 9th Investor Summit, Peter Schiff. Plus, returning for his 9th Investor Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus, lots more to be announced. It all begins June 11th in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys, Peter Schiff, Ken McElroy, and an all-star faculty on the 19th Annual Investor Summit.
Don't be like Charlie, who scans the internet for IRA information, often getting bad information from copycats who have no idea what they're doing. You deserve to work with a reputable firm that specializes in one thing, the EQRP. Lucky for you, Congress just made it possible for you to get up to $200,000 out of your current 401k or TSP, so you can invest that money in real estate or even your own business. Even if you're still working, it's possible to get access to all this money tax-free. Whether you're a full-time investor, a doctor, or a government employee, even if you have employees, the EQRP is your secret weapon. You'll never see this strategy in Money Magazine, only here with the Real Estate Guys. Every major accounting firm in America is quietly sharing this strategy with their wealthy clients, helping them get their funds freed from 401k jail. Hi, I'm Damian Lupo, and we have your solution. With the CARES Act expiring soon, this strategy will be gone forever. The EQRP company is ready to help you unleash your retirement funds now. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report today.
Hi, I'm Mark Victor Hans. You're listening to the Real Estate Guys. If you want to expand your consciousness, expand your wealth, expand your future, and have more delight and excite in your future than in your past, keep listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. There's still time to get signed up for Create Your Future, the 2021 Goals Retreat. If ever there was a time to get centered on your life and your goals and your future, it's right now. The event's been moved to Dallas, Texas. All the details at the website at realestateguysradio.com under events. We're talking about investing in larger properties and the commercial lending associated with that. Before we get back to our interview with Anton Mattli, it's time to play Real Estate Trivia. Your chance to win a prize by knowing today's Real Estate Trivia question. The question will be in the holiday spirit, and as soon as you hear it and think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You'll want to send us your name, the answer to the question, and your physical mailing address, because if you win, we're going to send you an awesome book called Life-Defining Moments from Bold Thought Leaders, a collection of inspiring stories. That can be yours if you know today's Real Estate Trivia question. Last week on the show, we were back in Belize and we asked this: which famous filmmaker owns 3 resorts in Belize? Well, the answer is Francis Ford Coppola. He owns Turtle Inn, Blancano Lodge, and Coral Key in beautiful Belize. Here's our real estate trivia question for this week. In what country was tinsel invented? Yeah, you've probably seen some tinsel recently. Well, where was it invented? If you know, or just want to take a guess, send us your best guess to trivia@realestateguysradio.com. trivia@realestateguysradio.com. Be sure to include your name, the answer to the question, and your mailing address. The first person that gets it right gets this awesome book, Life Defining Moments from Bold Thought Leaders. That's today's real estate trivia question. It's multifamily finance, and we're talking about whether you are currently in the market to buy a multifamily property. You're thinking, one day that's where I want to go, or maybe even you're passively investing with folks that put these kinds of deals together. We're learning a ton, and our guest is Anton Mattli. And I think you were sharing with us, Anton, before the break, just the current state of affairs. And if you're listening to the show in its natural order, then, we know what's happened, but we don't know when you've caught this show. People go back and listen for years. And I think the point isn't about COVID. The point is things change all the time in underwriting. And if I'm only doing a project every 6 months or 12 months or every couple of years, I'm not going to know the latest and greatest. I know in March and April, we had a lot of syndicator friends who got kind of caught flat-footed because all of a sudden the lender required another $500,000 in reserves, and they hadn't planned for that. So I think the lesson is you've got to sit down and talk to your loan professional before you make any assumptions or take any steps. So let's talk about that, Anton. It's actually something you cover in some good detail in your report, but working with somebody to help you get this loan is a little different than it is with residential. So when you sit down with somebody, your mission is to make them look the best they possibly can, to make sure the financials are presented in a way that there's a likelihood for success. Take us through that process.
Yeah, sure. This is a really important element to figure out what is the story that the sponsor has and the sponsor brings to the table, right? Obviously, we discussed before, the property is the key. If the property is not good, the best sponsor is not going to help, right? However, the property can be great. If the sponsor doesn't have the story right, it doesn't matter, because the lender will realize very quickly that the sponsor is not really suitable to buy and run this property in a professional fashion. And then we are back to that watch list I mentioned earlier. That's not what lender wants, right? So what we work with sponsors, particularly new syndicators, to ensure that they have their story right, that they have the team together, right? Whether it's other key principles, as we call them, that are likely co-guaranteeing the loans, that are helping with the due diligence, helping with asset management, that they have the lawyers lined up, that they have the property management lined up. Everything needs to be lined up before you make an offer. So that's where we talk with them. We look at their personal financial statement, identify what they claim is a net worth, what it really is, what counts as liquidity, what doesn't, as well as the real estate on schedule. Do they have any problem properties in there? Because a lender will look at that, right? If someone is invested in properties that have some problems with a low or negative debt service coverage, the lender wants to know about that. So we essentially prepare these sponsors for the questions that are going to come down the road, right? So that's the first step. Once a sponsor looks at the property, we obviously cannot underwrite every single deal that they'll look at, particularly in the current environment where you sometimes need to look at 100 properties before you win a single deal. However, once they have a deal with the initial underwriting, it makes sense, they want to have it, make a run for it, then we recommend that they come to us. We underwrite it from a debt perspective and give them guidance and essentially validate their assumptions they made for the debt piece.
Yeah.
And when we all agreed, yes, that's right, then they can run with it, submit that offer. Hopefully the offer is accepted. Then we get additional quotes from lenders. We pick the right lender for them. They apply for the loan, and then we handhold them through the whole process all the way to closing.
Well, and this is a great key part of it, is that you look at a lot of deals. You've seen what works, what doesn't. You know who's funding loans and what they have to look like. So a great mortgage broker is going to sit with you and look at your situation and say, hey, based on everything I see here, the condition of the property, any CapEx that needs to be done, your experience resume, here's where I think it should go, right? And you package it up that way. And it can be a process. So I might buy a single family home and, be closed in 30 or 45 days. How should people prepare themselves for the timeline? How much time does it take to get a big multifamily loan?
That's a very good, important point too, right? Particularly with newcomers, sometimes they submit an offer. They already are under a PSA, as we call it, purchase and sales agreement that was already signed, and they say, I need financing. And then we look at that PSA and it says, well, closing in 45 days. Right? We tell them, look, you can close in 45 days, but we will not get an agency financing. Now you need to likely go with a bank loan or a bridge loan, which is not necessarily what you want here. So it's important to understand depending on the type of loan that you're looking for, how long it will take. For an agency loan, it typically, in ideal world, it may take 35 to 40 days, but you really should count around 60 days to 80 days in the current environment. Particularly, we always recommend to have 60 days from effective date to closing with at least 2 times 15 days extension options, so that you have a sufficient amount of time to cover unforeseen circumstances, which, as we know, pop up almost all the time.
Yeah, no two deals are exactly alike. So good stuff. Hey, you touched earlier on third-party management. I just want folks who have never been through a multifamily transaction to just get this pretty clear. You know, there's a lot of folks that own single-family homes and they go knock on the door and collect the rent. You really can't do that in this case unless you have personally a seasoned property management business. One of the safeguards that lenders put on these bigger transactions is that they're going to vet the manager, and they want a manager that's professional, well-known, and is third party. Do you have any insight there on how folks find that kind of a manager, or how important it is that that team member is selected?
Yes, the property management company is really crucial. And the best way to really find them, obviously you can search them on Google, but that is not necessarily giving you the true answer. You need to network with other property owners that own properties of a similar size and a similar class, and ask them what their experience is with that company, right? So now you have massive companies like Greystar. They are an excellent multifamily property management company for large A-class properties, but you shouldn't hire them for a C-class or B-class property that is smaller or is in a rougher market. It's just not a good match there. So it's really important that you understand who are the property management companies out there that cover your type of segment of property that you are planning to acquire.
All right, great stuff. Well, there's a ton more we could go into, but if you're interested in this, you want to get your mind around it before you pull the trigger on something, Anton has this awesome report. It's called Ultimate Guide to Financing Your Apartment Complex, and we'll tell you how you can get that when we come back. Thanks so much for sharing with us, Anton. Great to get to know you a little better today, and we appreciate your experience and your insight.
Yeah, thanks again for having me on, Robert.
You're tuned to the Real Estate Guys radio program. More when we come back. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is a logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South home buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hi, I'm G. Edward Griffin, author of The Creature from Jekyll Island, a second look at the Federal Reserve. And you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you hurry, you can still get in to create your future. The 2021 Goals Retreat. It's coming right around the corner, and we'd love to have you there. We've moved the location to Dallas, Texas, and you can get all the details on our website at realestateguysradio.com under events. We're talking about financing apartment businesses, apartment complexes. It's a little more complex than single family, but that's why you bring in help, and certainly great to hear today from Anton.
Yeah, I come out of the mortgage business, and I always said the very first person you really need to have on your team that needs to be right by your side all the time is your mortgage professional, because your borrowing power is one of your most valuable assets, and you want to manage that proactively right alongside with your taxes. But when you step up into commercial, it's a whole different ballgame, as we said at the top of the show. And clearly, listening to Anton talk, you can hear that that's a very different thing. But the role of the broker, as opposed to a loan officer, is really like your resume coach. This person's going to take you and coach you up on how to fit into the box the lender wants to put you in. And, there's two ways to learn that. You can just go try and get rejected and make a bunch of mistakes, or you can have somebody that's been there, done that, grab you way ahead of the process. Something you said, Robert, which is really, really important, is you don't start going out looking at properties when you want to be an investor. You have to start out going and building a team. And the team, one of the most important people, is going to be that person who's going to coach you on your borrowing power, so that when you get into a transaction and you're actually looking at a deal, and the best deals always go fast, the best deals are always competitive. And if you want to be competitive, then you better be well advised and well supported, and they will make sure that you're in that position and you've had all the time to get yourself in that position, so that when you actually get into contract on a deal, you're going to be a good buyer. You're going to be a good candidate for getting that deal over the line, a good borrower. The team is going to make money. You're going to make money, and it's going to be a lot less brain damage. So please, please, please get the report, read it, and then get somebody on your team who can coach you through being a great commercial lender. Because if you're going to do this business, this is the space you're going to live in.
The report's called Ultimate Guide to Financing Your Apartment Complex. It's pretty thorough stuff here. I'm impressed with the detail, but it's not going to be over your head. Anton does a good job of explaining some of the basic things we've talked about. He goes into great detail about each of the sources of financing and what some of the differences are there. To get the report, all you have to do is send an email to multifamily@realestateguysradio.com, multifamily@realestateguysradio.com, and we'll whisk that off to you. It also has a great little bio about Anton and his contact details. If you want to reach out, you can. Russ, you make a great point. People buy houses and second houses on impulse, and they figure, well, I can afford it, and they go and get the loan afterwards. But this is backwards. You really have to have the financing piece first. You almost can't start too early with the financing, especially with complex commercial transactions. So super happy to have Anton on the program today. And to get that report, just send an email to multifamily@realestateguysradio.com. Hey, it's not too early to get signed up for the 19th Annual Investor Summit. It's the highest level event we do, and it's going to be extraordinary. The dates are June 11th through the 19th. For the first time ever, we won't be on a cruise ship for any of it. Instead, we'll be in beautiful Belize. We've got an incredible faculty, including Rich Dad advisor and best-selling author Ken McElroy, sales legend and extraordinarily amazing person Tom Hopkins, the editor of the Gold Newsletter and promoter of the New Orleans Investment Conference, Brian London, Jim Rohn's 18-year business partner, Kyle Wilson, the $200 million man, Dave Zook, and returning for, I think, her 18th summit, real estate developer extraordinaire, Beth Clifford, plus lots more. You can get all the details on our website at realestateguysradio.com. Just click the button that says Summit. You'll learn all about the legendary Investor Summit. It is the most wonderful time of the year. We have lots of great shows planned for 2021, and we hope it looks like a completely different year than this year. So until we talk next, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.